Welcome to a new episode of the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor, period. And to that end, we have a real treat for you today that will make you a very, very smarter investor. DoubleLine Deputy CIO Jeff Sherman. Jeff, good to see you. It's been a while. Thank you for coming on here. So for those not as familiar with DoubleLine as I am, having covered you guys and talked to you many times, what does the business look like today?
Yeah, we run a little bit over $90 billion in assets for a very diverse set of clients out there. We run institutional money, we run private placements, as well as publicly available 40 Act funds, think mutual funds and exchange traded funds. If you think about the way we invest, the bulk of our assets today sit in the fixed income arena. We focus on products that are kind of more traditionally oriented from the standpoint of thinking about what people think about when they think about the broad bond market, like the Bloomberg US aggregate, to very customized strategies, whether it's that limited interest rate exposure risk on the low duration front, whether it's a credit specific strategy where people are looking to kind of actively allocate across the fixed income space. But at our core, we're an active manager. And so what we try to do is use kind of the top down macroeconomic landscape to inform views about how we see the world, and couple that with bottom-up security selection through fundamental analysis with the analysts that we have that are experts within their specific areas of the fixed income market.
I imagine over the past month, you've really been leaning into the active side because it has been, some would say, bonkers. Of course, we saw the big stock market slide in early April after Liberation Day. We've seen markets stabilize, but we still have the 10-year close to 4.3%. It was a little bit higher than that. What have you been doing, and what have the past few weeks been like for you and your clients?
Yeah, it's pretty interesting, Brian, because you would think being an active manager that we've been extremely active in trading and moving our allocations and credit exposures around. But you have to think back about the landscape we came into in 2025. And what I mean by that is that we had a market that had very high valuation. You think about the stock market, people talked about the price to earnings ratio, the CAPE ratio, that long-term PE being extremely elevated levels. We also had it in the credit markets as well. In the credit markets, that's referenced by tight spreads, the incremental pickup that one gets for investing in credit assets over kind of treasury assets. And so what we found during the month of January, coming into the inauguration, was assets were still on a tear since that post-election run. And essentially anything credit-oriented or anything risk-oriented was really doing quite well. And so as we sat down our asset allocation committee meeting, as we went into kind of February, we said, look, this administration seems like there's going to be provoking a lot of uncertainty, right? We weren't sure about Liberation Day. We didn't think it would be as severe as anyone else. But what this led us to do after giving the run on the assets and knowing that there's heightened uncertainty was reduce some of the credit risk within our portfolios back in February. And again, it wasn't because we saw Liberation Day that was coming in 5 weeks' time. It was more the standpoint of saying, look, spreads are tight. There's not a lot of incremental risk premium out there in the marketplace today. And if we live in a world that has heightened uncertainty, right, you should command a higher risk premium. And so what that made us do was kind of rotate some of those assets into kind of more high quality things like government guarantee, like treasuries or agency mortgage-backed securities. And so what happened on Liberation Day, obviously, it was much more fearful than people thought. It was much more extreme than people thought. And in some ways, parts of it have gotten significantly worse since then, although you mentioned the markets have rebounded. So what we've actually been doing in our portfolios over the last 3.5 weeks since we've been liberated is that we actually have just been re-underwriting risk in our portfolio, making sure that we're comfortable with it, making sure what we own is what we want to own. And we haven't actually been highly active in today's market. And why is that? Well, because there still is uncertainty, right? Markets have rebounded in some way. They've retraced somewhere between a third to half of their levels. When I talk about spreads, the sell-offs we've seen in credit assets, but really, I feel like the uncertainty hasn't changed, right? We still have an elevated level. We still have these uniform tariffs that are out there. We have an extremely elevated tariff policy against China, which is having a significant impact on kind of the trade data. We got trade data this morning. The deficits at a new nominal record out there as well. And so what's happened out there is that some of this like buy the dip mentality has came into the marketplace, And right now, we just don't think it's a good time to be adding to risk in portfolios. So we liked our positioning coming in. What we've done is reassess where we are in terms of that return to risk payoff that we see in the future. And today we're very comfortable with those assets. But again, we're looking for some direction in the marketplace today. And again, I would say in the last 3.5 weeks, all we've seen is more turmoil, more uncertainty. And it doesn't give you as an investor this nice, fuzzy, warm, fuzzy feeling of wanting to up one's risk budget today.
Jeff, I love the Yahoo Finance community, but they, I think, are very active with the top 7 largest stocks in the world. This is Apple, this is Nvidia, this is even a Tesla I'll throw it in there after its post-earnings rally, and they only pay attention to the headline on the 10-year yield. And if that goes up, they are trained to think stocks go down. Frame this for this community. How important is it that we are seeing the 10-year above 4%? And then if it were to rise further as we layer on more debt, I haven't gotten to the potential next Trump tax plan. We layer on more debt on this country. How worrying is it if we do hit that 5% level?
Yeah, I mean, it is worrying, but you have to remember that we went down below 4%, previous to this kind of this sell-off in rate yields and pushing them back up. And so the reason interest rates are important is because the 10-year treasury, it feeds the economy. That's kind of how mortgages are priced when the homeowner goes to take that out. You can think about longer-term corporate debt. It's how corporate America finances itself. And so what that does is that feeds into kind of mechanism, and it also leads as a discount factor for thinking about your future earnings and how to value stocks. Now, the issue that we've seen is that rates have been extremely volatile, and they're volatile for kind of 2 reasons. And I call it this push and the pull that you have in the markets. So the push of rates going down is is really the fear that economic growth and activity is going to diminish, right? And some of that is because of the tariffs, right? It's because of the uncertainty of the policy. It's because of the unknowns out there. And again, if prices are going up meaningfully, it probably reduces overall consumption. And so from that standpoint, that is a growth scare, I'll call it, which pushes rates down. On the other hand, I don't have to rewind the clock very far. We can take it back 3 years to when we had very elevated levels of inflation. And the bond market has not forgot about these levels of inflation. Now, I'm not saying we're going back to a 9% inflation rate, but what's happened there is that the bond market now realizes that it has to price in inflation uncertainty. And what that means is that if the bond market thinks there's a level of inflation, it will command what we call a real yield, that incremental yield above the expectations of inflation, but it also has to price in some uncertainty around that inflation level. And because in the short term, tariffs can be inflationary, right? The bond market is struggling with what is the inflation narrative today. And also that kind of pulls rates higher. And so these 2 things are kind of battling one another. And you mentioned 430. Well, if you actually look back over the last, let's call it 18 to 24 months, what you see is the 10-year trading range has really been, kind of like mid 360, call it 365 to about 470. So where does that put you at a 430 today? We're roughly in the middle, maybe slightly above the middle of that range. But what you've seen is these push and pull factors have been driving, the 10-year up and down. And so if the tariffs come through and there's price pressure out there, and look, you saw Amazon be castigated by the White House this morning, right? For the idea that they were going to publish how much of the tariff is pushing that rate price up. They were talking about that policy. But this is the idea that ultimately, if that has to pass through, that's going to cause higher prices. And these higher prices will ultimately change the consumption pattern of the consumer. And the challenge is that, the problem that this administration has is they want us to buy American. They want us to buy goods that are produced in the USA. And there's nothing wrong with that. That's an admirable goal. The problem is we don't have substitutes for a lot of these goods that we consume that are produced in the US. So if we want to buy them, we have to pay the higher price, or we choose not to consume them, which can cause pain for some of those industries. And so this is the dynamic going on in the marketplace. And this is why I talked about there being massively elevated uncertainty today. And then you brought in the policies that the administration is trying to push, right? That they want tax cuts. They want to extend the TJCA from 2017. They probably get that done, but then they want an incremental tax cut on the back of that as well. And again, are they going to be able to find the funding? Thus far, what we've seen, and you look at the quarterly refunding of how many treasuries are going to be issued that was announced yesterday, it really hasn't changed the dynamic of the market. So for all this talk about Doge and government efficiency, and we're going to reduce the deficit, thus far in 99 days in, there hasn't been a lot of progress. That said, the onus typically sits with Congress, not the president, to push these policies through.
All right, hang with us, Jeff. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back. Having a great chat here with Double Line Deputy CIO Jeff Sherman. Of course, continue to hit us with all those likes on the social media platforms and podcast platforms. Always enjoy your feedback, and it's always very interesting stuff. Look, Jeff, I don't want to sit here and be someone in our field that is trying to get headlines, but people are telling me this summer we might be headed toward a bond market crisis. They point to the trade war. They point to potential debt. They point to an economy that might be in a mild slowdown. All these things seem plausible to me. Do you see a potential bond market crisis this summer? And what in the world would that even look like? And what would it mean to markets?
Yeah, well, I mean, look, the deficit's obviously something that's untenable in the long run. And so it's something we need to address. And as we talked about in the last segment, I was talking about the idea of like trying to reduce the deficit, having more policies that were friendly towards that. But what that means is austerity, Brian. And the challenge with that is that austerity means that we have to tighten the belt. That means we have to slow consumption. We got to quit spending money on programs out there. And that will obviously slow down economic activity. But then what happens kind of, again, this is like the ills of that side. It sounds great in theory, but the problem is once the economy slows, usually the government is the backstop to help ignite it once again. That is, they issue debt. They promote policies that are trying to promote job growth and the likes. And so it's that if we are austere and we cut the deficit, there's going to be a consequence, which may make us have to turn back on the spigot and increase the deficit again. So this is the challenge with kind of where we are in the overall kind of state of the markets today. However, you had talked about what does a crisis look like? Well, it looks like something back in, let's call it the fall of 2022, when we saw the UK gilt crisis. And what that was a function where the bond market responded to policy. There was a policy issued by then, I believe it was Theresa May at the time. And what happened, I'm sorry, it was Liz Truss at the time. I apologize. But what happened with Liz Truss was that she was talking about fighting inflation. They were going to do QE again. They were going to do tax cuts. Does that sound familiar, Brian? They were trying to stimulate to fight inflation, right? And the bond market said, no, you're not. And so that's what it looks like. It's when the bond market revolts. And watching the 2 weeks ago, people said, oh, the bond market's revolting because the treasury curve, and that's talking about the 2-year rate all the way up to the 30-year bond, most of them went up approximately 50 basis points that week. But what I point out to people is that, yeah, that's kind of what it looks like, but it's probably 50 basis points a day, and it's consecutive days. The other thing is that don't forget, during that 50 basis point rise, rates had rallied almost 50 basis points over the preceding like 6 or 7 days. So it was just kind of an inverse of some of that move. And so sometimes you have to step back and look at the bigger picture when you look at these micro moves. But ultimately, what it would look like is that the bond market is revolting against a policy. It's saying that, no, you cannot continue to pursue this. And that's ultimately when you know that the market has had enough. And what is it? There's the old quote about that, I want to come back as the bond market, right? I think it's James Carville that it's attributed to, right? Because it can bully anyone. And it's the biggest bully in the room. I'm paraphrasing there, but he did say he wanted to come back as the bond market.
Yeah, no, that's a good one. Somewhat, actually probably really tied to this. So one of the benefits of working at a company like Yahoo, you got a lot of data and you could very easily go back to certain things very, very quickly. I found you did an interview with my former colleague, October 20th, 2017, where you were talking about the Federal Reserve, Jeff, and you predicted that the next chair of the Fed would be Jerome Powell. It was right at the top of the story. I mean, my colleague did not bury the lead, so you nailed it there. Have you started to, and your team started to handicap on who the next Fed chief will be? And what do you think about these attacks on the Fed's independence from the president?
Well, let me take them in reverse order. Let's just start with the attacks. Is that one of the pleasures that we have, and as the U.S. and having the dollar and having the big bond market, is that we have the independence of the Fed, right? That it isn't leaning on the political whims, and we don't vacillate back and forth. As criticized as the Fed can be at various points through time, they ultimately are trying to serve the good of the people. They're trying to achieve their overall mandate. And so I think what you've seen from Jay Powell is that he has not been reflexively responding to the president. What you also see is that he's been adamant about he's staying in charge. And look, President Trump roiled the bond market and the markets in general by saying that he wanted that Powell should be fired. And so then he backtracked it. I think some of that was Scott Besson and Howard Lutton that get in the room with him and saying we need to do this. But ultimately, I think when you think about who the next Fed chairperson is, it's a political appointment. So it's probably someone who's going to align themselves more with the views. I think if you look at kind of the betting markets today, Kevin Warsh is the kind of front runner there, but he doesn't have a lot of confidence in there as well. And so I think the question becomes is that do you find someone who is going to try to shade themselves toward the political leans? By the way, from my understanding, Jerome Powell is a lifelong Republican, right? Hence his appointment the first time as well. And he's done a very good job of being independent. And so I think the independence of the Fed is extremely important because ultimately we saw this, prior to the era with Volcker, where you had, someone in charge of the Fed that leaned politically and tried to really push those policies and keep rates too low for too long. And so I think for as much criticism as Jay Powell has got, especially during 2022, he's done a good job since then of kind of having a steady hand, not reacting to whims in the data, looking at the overall data set. And at this stage, I think it's important, and the market really appreciates having that. And having someone who is not independent at charge of the Fed, then the question becomes, do the Fed governors start to have much more dissent as well, right? Because remember, it's supposed to be a policy. It's supposed to be cohesive. Usually the Fed chairperson is the one that brings everyone together. So we could see something more like what you see kind of at the Bank of England, where the votes are like usually eked out by one vote. It looks like a Supreme Court ruling, like a 5-4, right? Instead of this unanimous type of decision. So ultimately, I think it's very important, and there is a concern there. But the thing is that there's so many other concerns between now and the end of Jay Powell's tenure that I think I put it lower in the stack right now as we try to get through these tariff policies and what this trade war ultimately means for the U.S. economy.
So it doesn't sound like you're sold on Kevin Warsh.
Look, I don't know enough about him, to be honest. And, we had this discussion recently around the table here at Double Line was that, okay, well, what does it mean? If he gets fired, who comes in? It would be much more disruptive to fire Jay Powell and try to focus on today than get the next person. And I think it's way too early to be handicapping it. And again, I'm not against Warsh being there. I just don't know enough about him. And I think personally, I'll do much more homework as we get closer. And typically, usually the Fed chairperson is someone that's like about 2 to 3 months out from the appointment. You start discussing it. But they're talking about discussing it later this summer.
Jeff, I think it should be you, man. I think you toss your hat in the ring. You got my vote. Not that it matters, but
yeah, I appreciate that. I don't think I'd be liked. I'm not as pretty as Jay on the podium and stuff. So I'll leave it to those good-looking academic types and business leaders instead of myself.
Fair enough. In the last minute and a half, we always love to get a hot take from our guest, and I don't have anything written down here, but I love the complexity of what a double line does and how like nitty and gritty the business is. Give us like that one, I guess, complicated investment or trade that your teams have on right now that maybe the average investor could go out there and employ in some manner.
Yeah, I mean, look, I always say that the complication we try to make simple, and it's trying to distill the complexity down to basic facts and tenets and just inputs. So it's the building blocks approach. So I like to think about the portfolio and think about it as being somewhat simplistic. People always ask about what's the view on rates. And I don't have a very strong view now because of that push and pull dynamic we talked about earlier. But what we do have a lot of confidence in is what we call the shape of the curve, right? What we call a curve steepener. And this is being what we think is that the term premium, that is the amount that you get for lending longer, should be higher in the long term than where it is today. And that said, in bond speak, we would have a steepener trade on. And what that means is that we own the 2-year and we are short the 10-year or the 30-year asset against it. And so what that allows us to do is play the shape of the curve. So what we're saying is that we want to be long the front end of the curve, or we want to be inherently short the back end of the curve. And what that means is we're playing for that steepness of the slope of the curve. So it sounds complex. It's very simple. You do it in the futures market. You buy one contract, you sell the other. One thing is they have duration differences. So you have to adjust the number of contracts. So therein lies the complexity, Brian. But it is something that people could do with ETFs out there, right? There's ETFs that focus on treasuries on the front end and on the back end. And there's actually inverses as well. So you can be a long investor. You go long the front end, and you go long the inverse of the back end.
Like I told everybody coming to this podcast, you would leave as a smarter investor. It feels like I should be sending Jeff Sherman a check for all that stuff that he just told us. But good to see you, Jeff. It's been a while. Don't be a stranger. Hope to connect with you very again soon. Please do tell Mr. Gunlock the Yahoo Finance team says hello. Double Line Deputy CIO Jeff Sherman. Good to see you. We'll talk to you soon.
Thanks, Brian.
All right. Please do continue to hit us with the thumbs up on YouTube. Love all of the feedback, all of your comments. I always try to answer everything. Those 5 stars on the podcast platforms, keep them coming as well. They add up and really help us. We'll talk to you soon.